Dr.C.V.Suresh Babu's Virtual Classroom presents Business Economics series.
In this module, we are going to learn about producer's equilibrium, consumer's equilibrium, and discuss an example regarding the same. Equilibrium. Equilibrium is that state of rest where no change is required. Producer's equilibrium. When spoken in terms of producer's equilibrium, it means that any firm or company that produces a product or service that has reached a level of output where it does not wish to either expand or contract it. This producer's equilibrium state could be of maximum profit or minimum losses. In any business, the producer wants to maximize his satisfaction, which comes with more profit. The producer must reach a level of output where his profits are maximized. By having an optional combination of factors, a producer can reach a producer's equilibrium if his profits are maximum. The producer's equilibrium is also referred to as profit maximization condition. Producer's equilibrium refers to the state where the combination of price and output gives maximum profit to the producer. Consumer equilibrium. Consumer equilibrium refers to a circumstance when an individual is content with his or her level of income. In such a situation, an individual also does not want to modify his or her manner of outgoing expenses. A sensible customer will try to balance out his or her expenditure by making the least expenditure and gain the highest satisfaction. When an individual can do so, he or she is assumed to be in equilibrium. After a consumer reaches an equilibrium point, there is no reason for any modification in the quantities of availed product. Consumer's equilibrium refers to the point where he or she derives maximum satisfaction by spending money on the consumption of goods and services. I'm going to tell you all an example. You all know that profit is the amount received by the producers on the sale of goods which exceeds the amount spent on producing the goods. So for example, whenever farmer produces vegetables, he incurs some amount that reflect the money spent on labor, raw materials, etc. This is termed as cost. By selling the vegetables, the farmer receives some amount which is termed as revenue. The difference between revenue and the cost is the profit. The consumer, that is, the person whom the vegetables are sold to, is said to be in equilibrium when he feels that he cannot change his condition either by sending more or by changing the quantities of the vegetables he bought.
Thank you, friends. We will meet you at the next informative video. Until then, take care. If you like the video, like it, share it, and share your valuable comments with us. Do subscribe our channel for more useful videos. Take care. Have a nice day.
For more detailed information, refer to our book, Business Economics Simplified, by Dr.C.V.Suresh Babu. Highlights of our simplified series. Why should I learn this chapter? Snapshot. Frequently asked question. Summary. Activity. Assignment. Video online. Just before exam. Test yourself. keywords. Further readings. For more tutorial videos, subscribe to our YouTube channel.